$40,000 in momentum gains you're about to watch evaporate. That's what happens when index funds buy newly added stocks like Marvell and Flex, and you stay holding through the rebalancing cycle. You've heard the narrative. Index additions are fundamentally sound, approved by professionals, vetted by S&P Dow Jones indices. That's partially true, but there's a trap underneath that costs dividend investors and passive portfolio holders tens of thousands in opportunity cost and sector rotation drawdowns. And if you're watching this, you might already be sitting in one. Here's the problem. When a company joins the S&P 500, index funds have no choice but to buy. You do. And the difference matters more than you think. Research from Bender et al. 2013, on index reconstitution published through SSRN, documents a clear pattern. S&P 500 additions experience 1-3% price acceleration within days from mechanical passive inflows. That sounds modest until you do the math. A $500,000 index portfolio holding Marvell at plus 8% post-addition equals $40,000 in unrealized gains. But, and this is critical, that gain is momentum, not fundamentals. It's algorithmic money, not smart money. Historical data shows what happens next, and this is where it gets painful. Within 6-24 months, if underlying sector valuations don't support the elevated prices, mean reversion kicks in hard. The semiconductor sector has averaged 15-20% corrections during post-rotation cycles. If that happens, your $40,000 momentum gain doesn't just flatten. It reverses into a $50,000 to $75,000 drawdown if you're still holding at full weight. That's a $90,000 swing between making the right move and the wrong one. Why is this happening right now? Marvell Technology and Flex Limited were formally added to the S&P 500. Index funds track specific weighting formulas. They don't evaluate fundamentals independently. That forced buying pressure is real, quantifiable, and short-lived. FactSet data on index additions shows the buying climax typically occurs within 3-5 trading days of inclusion. After that window closes, the stock trades on its own merits. But by then, retail investors are already committed. The hidden risk, your portfolio concentration during rebalancing. During these events, semiconductor exposure alone can swing 8-12% of a $500K index holding. That's $40,000 to $60,000 in sector-specific volatility you didn't actively choose. And here's the kicker. The BLS Producer Price Index for semiconductor manufacturing shows sector-wide pressure building through 2024-2025. That means the fundamental tailwind that should support these valuations is weakening, not strengthening. You're buying into strength heading into weakness. Here's where most buy-and-hold investors get blindsided. They confuse index selection with fundamental validation. They think the S&P 500 includes it, so it must be solid. But S&P inclusion criteria focus on liquidity, market cap, and regulatory compliance, not forward valuation or earnings trajectory. The index doesn't predict sector health. It reflects current market cap and trading volume, nothing more. So what should a dividend investor or passive portfolio manager actually do? First, recognize the timing window. Index rebalancing pressure peaks within 5-10 trading days of the announcement. That's when the algorithmic buying is most aggressive. If you're going to trim exposure or rebalance, do it before that window closes, not after the stock has already rallied 5-8%. You're fighting dollar billions in passive flows if you wait. Second, separate momentum from fundamentals. Ask, is Marvell rallying because semiconductor demand improved or because passive index flows have no choice but to buy? Check BLS data, earnings guidance, and forward guidance. If the sector is consolidating or contracting, momentum gains are temporary. Third, and this is the tactical move most people miss, consider tax loss harvesting paired with rebalancing. If you hold Marvell through the post-edition rally, you're creating short-term capital gains inside your index fund. When the correction comes 12-18 months later, you can't harvest those losses without triggering wash sale rules. But if you trim into the rally and redeploy into a sector with better fundamentals, you preserve flexibility and reduce your tax liability simultaneously. The research is clear. Index additions create measurable but temporary price premiums. Historical studies show they fade. Your job as an investor is to recognize the difference between index flow-driven momentum and sustainable fundamental strength. The decision point isn't after the rally, it's before. Markets reward the patient and the prepared.